Will you be comfortable doing banking completely on Facebook or WhatsApp? Well, that could be the future of banking with banking as a service. So, what is banking as a service? How does this work? And what could be the impact on your life? Hi, this is Sam Ghosh, and today we are going to talk about banking as a service. For customers, banking as a service means getting access to banking services from non banking companies. One example is Singapore's ride hailing company Grab, who embedded payment services on its own wallet. But behind GrabPay sits, among other services, the Dutch payment company Audion, which provides e commerce, mobile, and point of sales payments through an API driven platform. So, customers are receiving the payment services from Grab with Grab's branding, but in reality, the services are provided by Audion. This is banking as a service. So, how does it work? Banking as a service is possible with the use of application programming interfaces or APIs. From a business architecture level, banking as a service segregates the banking products and service providers from the distribution and branding. Entering banking business for non-banking companies is a tough job. There are multiple barriers to entry, from various licensing requirements, capital requirements, experience requirements, and operational complexity. The use of APIs makes it possible for digital platforms and ecosystems like e-commerce, social media, or ride-hailing companies to offer loans, credit cards, and savings accounts co-created with the bank to their own customers under their own brand name. The non-banks can use these financial services as growth levers for their own business or separate revenue sources depending on use cases and their negotiating power. Consider an e-commerce company who offers consumer credit at the point of sales on its own platform without the customer having to enter any other information. Quite expected that this is going to increase the conversion for the e-commerce company. On the other hand, many social media and chatting apps have enormous traction in the form of millions of daily active users, which these platforms can monetize using financial services. These platforms can earn commissions or share of interest, interchange, or other kinds of financial revenues. Consider WeBank, which uses chatting apps such as WeChat, QQ, and video sharing apps for distribution of their credit products. WeChat and QQ are both very popular chatting apps in China with a huge number of active users. This made WeBank's rapid growth possible. WeBank was founded in late 2014 and currently has over 200 million customers. WeBank, WeChat, and QQ all are owned by Tencent. It is worthwhile to mention banking as service providers such as Solaris Bank, who can help any company provide banking services from their own platforms. Not only banking services such as lending, payments, or know your customer services, non-banks can actually build totally functioning banks with their own branding on the top of these banking as a service platforms. These BaaS providers give access to licensing, infrastructure, and manage banking operations. All the non-banks need to do is branding and distribution. As banking as a service uses APIs, it can be confused with open banking. Is it different from open banking? There is a fundamental difference. Open banking is a policy structure that empowers consumers to share their banking data with third parties. It is about data sharing, Banking as a service, on the other hand, helps non-banking companies provide banking services to their own customers from their own platform with their own branding. In a sense, banking as a service is an implementation of open banking concepts. So how does banking as a service benefits us, the customers? The primary benefit is less friction and higher convenience for the customers. Consider a travel website offering credit to frequent flyers directly from their website, or Facebook or Twitter giving loans to small businesses who run their ads on these platforms. Banking services are often very standardized and ignore the individual needs of their customers. Many non-banks, especially tech platforms, often have much more data about the customers, and they can use the data to tailor financial services to address individual pain points of the individual customers. For example, your grocery store offering you credit on the items you repeatedly bought and option of end of month settlement, or an e-commerce platform allowing you to recurringly save for an expensive and aspirational product on your wish list. Apart from convenience and innovative products, availability of more options means higher competition and lower fees and interest rates for the customers. As banking as a service makes it possible for non-banks to enter banking industry, there will be a plethora of services competing with the offerings of the banks, effectively lowering the cost of banking for customers. While we talked about all the good things about banking as a service, there are some potential pitfalls that the consumers need to be aware of. The first issue is that the segregation of service provider and distributor means that consumers may not always be clear about exactly which company they are buying the service from and with which company they are entering a contract. There are no issues when the things go smoothly, but in case of a dispute, the multi-party structure may lead to communication and legal complexities. Now, what happens if the non-banking company who branded their financial products goes out of business or discontinues the services? Will the issuing bank fulfill all the promises expressed by the branding company? The second issue comes in the disguise of benefit of ease. Banking as a service will remove friction from many transactions, and doing that can encourage impulsive financial decisions. An easy credit may mean expensive and unnecessary credit. For example, point of sales financing or buy now, pay later may encourage overspending or unnecessary spending. Over-availability of financial products and services may lead to complicated financial lives, making it harder for us to track our financials. Think about having credit cards from each retailer you shop from, or depositing money on multiple wallets for multiple e-commerce companies. Now, last but not the least, the threat of leakage and misuse of financial data. As per reports, APIs are coming under more and more attacks by the cyber criminals. Banking as a service fundamentally increases the surface area for cyber attacks. Another related concern is how responsible and capable these non-bank distributors are in handling sensitive financial data. How are they using the data and for what purpose? Regulations may vary from country to country, but consumers need to be very careful about this. Banking as a service is not a distant future. It is already here. If you are making payments directly from your bank account without logging into your bank account, or using a prepaid or credit card issued by a retailer or a ride-hailing company such as Starbucks prepaid reward card or Lyft debit cards, you are already using banking as a service. Many neobanks without banking licenses are also examples of banking as a service. So it is quite possible that you are already using or going to use banking as a service in the near future. It is worthwhile to understand how it can affect your life. While banking as a service is going to enrich our lives with an array of financial services tailored to our financial lives, it is expected to make our financial lives a little more complex. At the same time, we consumers need to understand who exactly we are doing banking with, irrespective of the branding. We also need to be very careful about which parties are getting access to our banking data and how they are using it, or whether they are protecting it properly. With this is Sam Ghosh. Thank you very much for watching. Bye bye.